Right, good afternoon to everybody. Also, thank you to April and Anis for those introductions that did quite give us a good account of how things are uh, preparing, and maybe can also give us a good understanding of why our market seems to be stuck inside a consolidation range, which I feel though is generally driving a preparatory type of move to eventually break through resistance. And for now, we're going to have to be able to keep ourselves very focused on things. We can't just buy anything there. You have to be very specific at what you're doing and focused. And maybe throughout our presentation, we'll just run through some of the details that we're going to have to do and how we're going to try to be able to do that focusing into some of the issues that we will look to cover. So let's just begin on how things have fared since we talked about things last time in our last outlook compared to how things actually took place. And if you were to look at the Philippine Composite Index, or the PSEi, during that particular period, you would be able to see that in this segment here, we were quite at a bit of a trouble because index was actually coming to test major support levels. This was sometime in the end of July last year, coming to August. And what we were saying is that we were hoping that the market would generate a higher low base and then recapture the recovery to try to be able to swing back up. And the targets that we were looking at was between a range perhaps closer to 7,100, maybe even 7,300 at that particular time. Now, what actually happened is that we did see the market actually base out, generate the higher low that we were looking for, and that supported the ability for it to be able to allow demand to pick up quite nicely. And with that, we saw quite a bit of a surge in prices. And if you notice here, at resistance, we see a bit of a consolidation, which took maybe about sometime like a month long to be able to generate, and eventually it broke itself out and pushed all the way back up, even passing the targets that we were looking at earlier, to hit a high of about 74.75. And since then we've been consolidating in this range between 74 and about 6,950. So with that particular view, we did see what we wanted. That means a higher low base into the index. So at least that scenario did come up. However, we were not able to pick out the actual target of that rally because it actually generated itself stronger than we anticipated, because it went from the high band we were looking at 7,100 went all the way up to 74.75. I mean, I don't mind being wrong as long as it's always on the plus side. Second is we also were looking at a strong U.S. market to be able to continue for that next 6 months, and it did, but it did need to be able to generate a pit stop, and that pit stop did happen between September and October, and from there on it went back into a new high. And of course, nowadays though, we've been seeing quite a bit of weakness for the reasons said earlier on by the other speakers. In terms of our view with commodities, we were saying that commodities could still remain strong and climb. However, yields may need to be able to correct. But we felt that this correction would only be very temporary. And sure enough, our commodities did continue, and that's why we're still having our inflation problem today. We have had bond yields also managed to be able to go through a temporary correction, and sure enough, it was temporary, and we still see yields relatively high. In fact, in the last few days, we've still seen US bond yields continue to move higher. Then we talked about the dollar's rise, and we were hoping that a particular pause or a correction would come inside. And we also were thinking that the peso-dollar would do the same. And it did, but it only did do that only very briefly. It lasted only for about a month or a month and a half. And after that we saw the ongoing rally into the dollar come back. And that, of course, led also to some weakness into the peso. So given that things seem to have gone to the direction we thought that it'd probably go to, maybe with some overperformance, where are we today? So today, let's look at the Philippines in the scope of some of the other markets that we have been seeing. In the chart on the left, you were seeing that the Philippine index produced so far a year-to-date return of about 1.8%, as compared to the S&P down about 8.7%. Shanghai Composite down about 5%, World Index, a totality of major markets, about down 4%, with the emerging market fund doing about down 1.67. So comparatively, I think we've done quite good job. The red line you see here on the right side shows how we've actually held on to that resilience as compared. Look at the other markets really coming back down already, and especially the US as of the big tech correction that we've been seeing because of the potential rise in rates. But we've managed to be able to hold on quite steady into a sideways streak. So this is the first good sign that I've managed to see, at least that we've had some resilience. It could very well be that what April pointed out is that since we've already had quite a generous amount of foreign selling, that the selling coffers may not be too heavy as of yet, and perhaps why we are not becoming too sensitive to many of the declines that we've had. Also is because we were not able to rally so much into the COVID recovery that we had because we kept ourselves on lockdown at an extended period, and only now do we see efforts to try to be able to loosen that. So that could also be another reason why we managed to be able to stay relatively neutral instead of very, very much of a decline. Now, of course, one of the concerns that I do have is that if you were to look at the general conditions of other Asian markets, you'll see quite a mixed picture. But much of the mature markets you see on this particular list, for example, those like the Shanghai index here on the right side, the Nikkei here on the lower left, you can clearly see breaks of support taking place from these particular markets. And to me, these are concerns because it's very difficult for us to just jump up very strongly when you've got the rest of the world going through a lot of pressure. And it's not only there. I mean, you can see the KOSPI or the Korean index down here on the right side really, getting pummeled. We do have some good to moderate markets like in Thailand and in India, also working in some corrections, but not breaking new lows. And the strongest of that list so far has been the Philippine index and the Indonesian market, which you could see here are holding sideways while everybody else seems to be going down. Also a little bit of some neutral movements from the Hang Seng, not really mimicking what you're seeing in China as of the moment. But at least the standout between this issue is that, again, the Philippines and perhaps Indonesia seem to be looking at something very different in order for them to be able to hold to that level of degree. So I will not say that we will completely decouple with the rest, because if we still see pressure in the other markets, it's very hard for us to be able to just jump up very, very strongly. So we're going to have to keep that in mind. So going back into the index, and we'll look at the weekly picture of this index. This is what I've had in view for quite some time, that we are in a major recovery situation, and that's this upper channel you see here. And we're now somewhere at the middle, and given the middle point, we're hitting the first zone of resistance, and this is the high part about 74, 75. And this is the next resistance that we have to be able to break in order for us to escalate into the next level, which I'm looking between 7,800 to about 8,250. And major support right now sits first at the 6950 zone, which is the low part here. And of course, just in case that breaks, then our next major support will be closer to about 6600. I really hope, though, that we maintain this particular band in order for it to serve as a launching pad for us to get up into the next zone of resistance. And right now, this is what we have. This is the daily chart of our index, and you can clearly see the consolidation band that you're seeing right below that 73, 7400 zone. And this is the preparatory part of our pattern that it's trying to make, because it's slowly trying to chip away at resistance. And we will see whether we will be successful in this endeavor. I think in the next perhaps 2 weeks, a decision should be made to be able to engage that particular level. So keep very close eye on this. If we do manage to be able to break up, part of the reason that I've managed to target that 78 to about 8 to 50 zone is the size of the pattern that we have over here. Tells us that the range of that is about 450 points in size. So if you get a breakout of this, potential target side will be that minimum of 7,800 zone. Of course, all bets will be off if the lower part of this range is disrupted. So this is what we should not be doing. And given that particular context, we want prices to stay kind of elevated so that good level of resistance can be taken out with a good chance for a particular breakout. So this is the scenario that I think would be more favorable to us. And I will have two situations drawn out here for you. The first is a very strong one, in which you'll see the index try to break out first, maybe just stop, pause, or pull back just slightly like this, and then of course work in its magic by trying to be able to rally back. Now here, this one is a more mediocre type of movement where some shock might actually push it back down before a breakout comes in, but that shocking situation will only allow it to be able to make a low somewhere closer to about 7,100, allow it to be able to make back a recovery to resistance, take out whatever is remaining there, and eventually just move on about that. So any of these two scenarios can lead to that recovery back to the 7.8 to 8,250 level that we're looking at. Now, what we don't want to happen is something like this. So never mind if some shocking events or things that can come in, as long as it shows its resilience, it will be fine. But if we do see the index come back and break that 7,100 zone, or even worse, come even closer and threaten that 6,950 major support level and our 200-day EMA standing right here, that could be quite a scary feat, especially if we do see a major break from that area. Then that means this entire thing turns into a reversal pattern, and we might have some, selling spree coming out from this if such a situation takes place. My bias, however, is more on this type of situation. And so if I would be looking at the market right now, I'd be preparing for this kind of situation rather than this one. But I presented this just in case, a small chance actually happens. We're ready to understand that if this blue line here breaks, we have to be able to lighten up in preparation for what could happen as well. So let's have a look at some catalysts and risks. I think some of our speakers did point out some of these already, but just to be able to briefly put them together. Of course, in the Philippines side, as a catalyst, the de-escalation of alert levels could be quite a bit of a catalyst for us to be able to look forward to. This will probably be the real first time that we can actually go back into a reopening play, since this last Omicron didn't really hit us bad in terms of severity and into the critical aspects like the way Delta did. And I guess that gave everybody a bit more bullish, and that is very reflective into the survey sentiment we sent earlier, and we saw the results of which. So I am hoping that demand can ramp up based on this condition. Now, another potential catalyst for us is this. The US market currently is at an oversold situation. If you look at the NASDAQ, it's down over 15% from its high. The S&P 500 is teetering about closer to down 10% from its highs. And this oversold situation is producing a little bit of a sideways movement in price. It's a little bit more difficult to predict right now because all the rallies we've seen in the last few days have just been, stepped on and punched back into a downside. So we're really watching this very carefully. And if we do manage to engage a rally, this rally will be temporary, but a rally nevertheless. And it's a rally, what we call a B wave rally, which is a temporary rally that maybe can recover 30 to 50% of the reaction that we've seen so far. If we do see a rally like that, that should be able to give other markets a chance to be able to rally as well. Now, the overbought situation also in the US bond yields is something that we're also looking at, and oil. It was also nice to hear that Anis also told us the reason why oil may have a cap in terms of the ability for shale oil to be an attractive medium to toss back into the pie to control the lack of supply conditions for oil. So given that, and the overbought situation may also prove to be quite helpful, since a pullback in oil might be able to deflate some of that inflative risk that we've been seeing in the market. And of course, a temporary correction, consolidation to the US dollar, which I think is coming to hit a temporary high point. May not be finished yet, maybe a little bit more, but an easing on that should also help try to be able to diffuse some risk that we've also been seeing into the peso dollar. Now, some of the risk involved is clearly nobody really knows if a new COVID threat may rear its head, a new mutation may come in, but that may take some time, maybe hopefully 1 or 2 or 3 months before we see it. I hope we don't even see it at all, but clearly it's a risk, and we've been taught to keep that risk in mind because we've seen so many variations already. Second, we've got presidential elections coming up, and although we do have a couple of months or 2 or 3 months ahead of that particular area to be able to start to drive that. But I'm a little worried that as we come closer to that day, some degree of worry or uncertainty may come in. So if we do see a rally, that might be an opportunity for us to take some profits first. And then maybe after the election time, maybe we can try to be able to plug in our positions depending on what happens right after that. Of course, the US correction could still continue. And this could be another risk that we may have to face. Before going to a B wave, we might see a continuation of an A wave. That's something that could drive the market to situation and even drive a heavier sense of capitulation. So that's something you have to look at. And of course, external threats such as possible conflicts, of course, like in Ukraine, Russia, China, and Taiwan. I mean, although we hope nothing happens there, we've been seeing a lot of news items coming out that might, throw some degree of concern into that. I think this is a low chance, but I wouldn't say it's a no chance. So let's quickly look at the S&P and the scenario I'm looking for a potential B wave. So we've seen quite a heavy correction in the US. It's now consolidating. And normally what happens after an overshoot like this is the ability for it to be able to make a rally. You can see an oversold condition here into its RSI. So the only problem here, it's really proving very difficult for it to try to generate that recovery as of there. So if there's going to be more continuation, I hope it will just be very temporary and then recover right away. And then this is the scenario that I'm looking for a potential rally for the S&P. So after this flush down, you will see a recovery that will come in, maybe take a shape of what looks like a wedge and try to be able to rally, maybe, like I said, 30 to 50% of that decline, maybe rally somewhere here. And then eventually you will have one more decline that will come to be able to meet out any other risk that they will need to be able to factor into their market. So please build that although there might be a rally here, it doesn't mean it's finished. This will be temporary just to offset the oversold condition. And we may be able to see another wave of that coming on a bit later, hopefully after a few months. In terms of yields and US bond yields and oil, this is one of the reasons why I'm thinking that a potential correction, temporary in nature, that could come in. I'm seeing a slowdown in upward momentum in the 10-year. You can see that very clearly to the momentum readings we have, and indications of overbought levels are very clear. Last time we have that situation here, you can see the correction that it managed to be able to come out with for the next 2 months thereafter. So this is a potential situation. Maybe even a sideways type might also be may pan out for the yield. Then oil, we also have coming in towards a high band of the range that I have pegged out here. Again, we're seeing momentum starting to be able to slow down. We also have overbought conditions, so that too may generate a bit of a reactive capacity or oil relatively soon. Although yes, the short-term trend is still up, and so is the long-term trend up, but perhaps a medium-term action here may need for it to be able to cool down somewhat. In terms of the US dollar and the peso dollar, I guess this is the part that still seems to be quite in the raw, because if you can see just recently the US dollar broke through the recent highs we've had, and it is though coming towards a high band of the range that I have pegged as a channel, and I would really hope that perhaps the dollar could be able to feel some pressure here, and it is also starting to be able to come closer to overbought levels as well, and so that might drive some new consolidation time. If you look at the peso dollar here on the right side, I think the clear band states itself quite well. We've hit about the 51.50, 51.60 range, and we're encountering some pressure there, and momentum indications are also slowing down. So what we hope to see here is more of a consolidation type, and if we're fortunate, maybe even pull back a little bit. Now, I think it might be difficult to go all the way back down here, given the context that we have a very strong dollar. So just make an area pattern here for the meantime. That should be good enough rather than showing more depreciated efforts inside. Because if we break through 51.50, 51.50 and 60, we'll go to about 57, maybe even 57.50 as the next level targets. So in terms of focusing on stocks, since we have a very split situation, I mean, I took the liberty of looking at where the activity was going into our sectoral components. So what I did is I looked at all the sectoral indices that we've had, plotted them all against each other and how they've been performing against our index. And this is what I've discovered so far. So we've broken this down into 4 sectors. We have a leading sector, we have an improving sector, a lagging sector, and the weakening sector. So if you see, for example, like the services index, which is all the way down here, this tells you that the services index has been a weakening type of index compared to the index, to our PSEi. The financials are the ones that are doing the best. So these are the leaders. That's followed by the improving ones, mining and oil, holdings and property. And those that are lagging are the commercial and industrials. Now, I looked at each and every one of these stocks here, and I've highlighted certain numbers of them that have some interesting technicals. They might be in these particular sectors, but some of them may actually be doing well. For example, the commercial industrials are actually lagging only because you've got weakness in ASEN and weakness in URC, and that drew the entire index down. But it doesn't necessarily mean that every single one of the components are lagging. So if I've highlighted them, that means there's still some prospect that they may be able to do better than what the other components of their industry have done. Now, the next component I want to be able to show you is this. I mean, April talked about net foreign selling, and she says that they probably sold quite a bit of positions already. Over here, I'm showing you a list of key issues. And these vertical bars you see here will tell you whether you have a lot of foreign buying coming into the stock, roughly since December to about January 24. And here on the right side that are in this red line showing you outflows on foreign movements. In particular, you can see the top 3 would be Monde, Jollibee, and URC. So I put this together, and now I'm going to try to embed some of this with some of the issues we looked at earlier so that you can see both of them in a good perspective. So here again, we have the leading issues. We've got BDO, Metrobank, and BPI. If you notice, they're colored green because colored green means that they are taking in foreign fund inflows. If it's color red, like you see here in Semirara, Felix, Megaworld, Robinsons, ICT, Converge, and Jollibee, that means you have outflows in foreign activity. So the reason I put this way, so if you're going to focus on the leading or maybe improving companies over here, just take note that some companies here, although they're improving, they are taking in quite a bit of exit from some foreign activity. And that means that you could generate more corrective volatility in the short term. And you might have to wait for pullbacks to next support, or perhaps maybe even a breakout before taking the opportunities for some of these ones in red. So please keep that in mind. So the ones that are in the weakening area, although these are weakening, these are 3 areas that still look okay, right? Lagging the same, and the ones that you see listed out are still issues that I relatively like. So put together, I have 6 issues over here that I view are issues that should be considered, particularly for those who are traders. I see very much preparatory patterns being built. For example, Ayala Core, we do have a symmetrical triangle. You have a rectangle in Boitish Power, ascending triangle, and maybe a rising channel in BPI. Manila Water also building a triangle. Recovery movements from Jollibee and Semirara. So these particular 6 issues would be my top on my mind for the meantime, at least into the next 6 months, and looking for opportunities that can stem from many of these, especially if we see breakout activities move on to them. I think we did see some of that activity in BPI earlier today, maybe even a bit in Jollibee. Although Ayala Corp tried earlier, it was sold down towards the close, but I will keep these 6 in here for the meantime and offer them as a potential trade activity for our retail traders. So as a summary, the PSE proceeds to consolidate, and I guess the other speakers have told you why. I mean, this is not smooth sailing. We are going to see a gradual recovery out of this, and this is the reason why the index is still relatively split. But it is trying to chip off resistance, and we hope a push above those 7,350 to 7,475 can lead to a 7,800 to 8,250 area. Now, yes, we do have some risk because as we are in a consolidation, nothing is 100%. So we still have that. There could be some headwinds that could steer up its head that could generate some more volatility before we get that and may allow things to maybe defer things in terms of activity. So we have to be quite selective in our buys. It's not broad-based. Focus on, and I agree with April, mainline issues. This normally begins the ability for a market to recover. Look for issues that are rebounding over their 50 or 100-day moving average or bouncing off them. These kinds of rebounds are the ones that you want to take in. And of course, if you see breakouts from the area patterns I showed you earlier, those will be clearly issues that you want to have to zero in on as well. The recent U.S. weakness, may have deferred the PSE's ability to break resistance, but I feel a little bit better than negative that we'll probably be able to do this and achieve that breakout of resistance. So let's keep an eye on that. But part of the catalyst I'm looking at is a potential B-wave rally into the US that may allow for that rally window. And of course, reactions in yields in oil could also prove to be quite a tailwind for us in generating that rally as well. But keep in mind, I think volatility may come back maybe somewhere in the middle or late into the first quarter and into the second quarter, as the B-wave rally into the S&P perhaps would come to an end. And we do have presidential elections that are coming in quite closely. I think there might be some degree of uncertainty there that might ask some people to be able to take some profits. And if you do that, then you wait for the next entry point that will come in. Hopefully after elections, we can probably guide you as to what we are seeing and whether we see more solid movements or whether they're something more defensive that we have to take in or more bullish. And we can guide you more after we see good account of how the demands and supply equations are framed.